Cost-benefit analysis. Meaning of cost-benefit analysis. Cost-benefit analysis, or CBA, is a data-driven approach to evaluating a project or decision's financial benefits and costs from a business perspective. A CBA involves defining the project scope, identifying costs and benefits, assigning monetary values, calculating the net present value, NPV, analyzing results, and making informed decisions. It compares the total expected costs against the expected benefits to determine the project's overall value and feasibility, often in the form of a ratio. A cost-benefit analysis, CBA, also called a benefit cost analysis, is a decision-making tool that helps to choose that actions are worth pursuing. It provides a quantitative view of an issue. Cost-benefit analysis is a straightforward method that compares the total expected costs of a project with its potential benefits. This technique helps to determine whether the benefits of the project outweigh the costs and if the project is financially worthwhile. Features of cost-benefit analysis. A cost-benefit analysis measures the benefits of a decision or action by subtracting the associated costs. It involves measurable financial metrics such as revenue earned or cost saved from pursuing a project. The analysis can also consider intangible benefits and costs, like employee morale and customer satisfaction. More complex analyses may include sensitivity analysis, discounting cash flows, and what-if scenarios for various options. Generally, if the benefits outweigh the costs, the project is favorable for a company. Goals of CBA. Identifying all relevant costs and benefits. In order to conduct an accurate CBA evaluation, it is important to identify all of the costs and benefits associated with a particular project or decision, including both direct and indirect costs and benefits. Assigning a monetary value to costs and benefits. In order to compare costs and benefits, it is necessary to assign a monetary value to each cost and benefit. Comparing the total costs to the total benefits. Once all relevant costs and benefits have been identified and assigned a monetary value, the next step is to compare the total costs to the total benefits to determine whether the benefits outweigh the costs. Providing decision-makers with a way to compare different options. CBA evaluation provides decision-makers with a systematic way to compare the costs and benefits of different options and make informed choices. Aspects of understanding cost-benefit analysis. Project initiation. CBA allows to forecast the viability of project by comparing the potential benefits and costs. Producer can decide whether to proceed or decline based on the expected value. Budgeting. Producer can manage multiple projects more efficiently with a limited budget. By evaluating the anticipated benefits, CBA will tell whether to approve allocated budget. Resource allocation. CBA can optimize resource allocation and distribute them more efficiently, especially when integrated with project scheduling software. Risk management. Using CBA, it is easy to assess risks and apply mitigation strategies, addressing risks and adaptively. It also enables to allocate a budget for potential risks based on the cost-benefit trade-offs of different contingency measures. Improving communication. Evaluating CBA can help justify your project decisions and enhance transparency with a quantitative approach, improving stakeholder communication. Policy development. CBA can guide new policies or regulations within the project framework to apply implementation strategies. The producer can ensure regulatory compliance by assessing the costs and benefits of different compliance approaches. Key components of a cost-benefit analysis. Cost. Direct costs. These are costs that can be directly tied to the project, such as labor, materials, and production expenses. Indirect costs. These refer to overhead expenses, like administrative costs or utilities, that are not directly tied to the project but still impact its overall budget. Opportunity costs. These costs represent the value of the next best alternative that give up by choosing one option over another. Intangible costs. These are harder to measure but equally important. Intangible costs can include reduced employee morale and employee satisfaction or a negative impact on your brand's reputation, both of which can have long-term consequences. Hidden costs. Often, there are hidden costs that might not be immediately apparent, such as maintenance expenses or interest rates on loans taken for the initial investment. Benefits. Monetary value. The most obvious benefit, monetary value, includes profit, revenue increases, and cost savings. For example, if a new product increases sales by 20%, that's a clear monetary benefit. Intangible benefits. These are benefits that are harder to quantify but still crucial, such as improved customer satisfaction, enhanced employee morale, or increased brand loyalty. Expected benefits. When conducting a CBA, it's essential to account for both potential benefits and expected benefits. Expected benefits are those that are reasonably certain, such as projected revenue from a new product launch, while potential benefits may include things like improved brand loyalty or increased market share. Steps of cost-benefit analysis. Step 1. Identify all costs and benefits. Start by listing out every potential cost and benefit related to the decision. The types of costs are listed in the previous section above. This should include direct, indirect, opportunity, and intangible factors. For example, if you're considering a new marketing strategy, you'll need to account for direct costs, ad spend, creative development, indirect costs, overhead, and benefits like increased brand awareness and sales. Step 2. Assign monetary value. Once all the costs and benefits have been identified, assign a monetary value to each one. Direct costs and monetary benefits are straightforward, but you can use surveys, industry standards, or benchmarks to estimate intangible aspects like employee morale or customer satisfaction. Step 3. Forecast future costs and benefits. Use forecasting techniques to predict how costs and benefits will play out over time. Many organizations use net present value, NPV, to adjust future cash flows into present-day terms. This helps in accounting for the time value of money, ensuring that future costs and benefits are fairly evaluated. Step 4. Consider discount rates and time frame. Apply the correct discount rate when calculating the net present value of future costs and benefits. A higher discount rate assumes greater risk, while a lower rate indicates more certainty. Step 5. Calculate total costs and benefits. After assigning values, calculate the total costs and benefits. This will give you the overall picture of what you're dealing with. Step 6. Determine benefit cost ratio, BCR, and net present value, NPV. Calculate the BCR to see whether the benefits outweigh the costs. Then, use NPV to see how much value the project will add in today's terms. A positive NPV indicates that the project is likely profitable. Step 7. Perform sensitivity analysis. Finally, conduct a sensitivity analysis to understand how changes in key variables, like labor costs or market demand, impact your outcome. Advantages of cost-benefit analysis. A data-driven approach, cost-benefit analysis allows an individual or organization to evaluate a decision or potential project free of biases. As such, it offers an agnostic and evidence-based evaluation of your options, which can help your business become more data-driven and logical. Makes decisions simpler. Business decisions are often complex by nature. By reducing a decision to costs versus benefits, the cost-benefit analysis can make this dilemma less complex. Uncovers hidden costs and benefits. Cost-benefit analysis forces you to outline every potential cost and benefit associated with a project, which can uncover less than obvious factors like indirect or intangible costs. Objective decision-making. Objective decision-making is a data-driven approach in which analysts collect and analyze data to help make decisions. This approach is fully evidence-based and free from biases, allowing for more informed decisions. Remember, CBA is a useful tool for collecting relevant data. Risk mitigation. CBA helps the project management team identify potential issues such as budget overruns, scope creep, resource allocation problems, risk management challenges, stakeholder conflicts, regulatory compliance issues, technological difficulties, quality assurance problems, market changes, environmental and social impacts, and communication breakdowns. Alternatively, if the project seems unprofitable, the company can drop it to avoid the risk of losses. Resource optimization. CBA helps you identify hidden costs associated with the project. This information provides the tools you need to generate alternate options for resource allocation and optimize resources to minimize costs and maximize benefits. Stakeholder confidence. CBA increases the chance of project success because the team will only select profitable projects. Successful projects help companies gain stakeholder confidence. Data-driven decision-making. CBA relies on hard data rather than emotional feeling, ensuring we make informed decisions based on facts. Quantifies intangible benefits. It allows us to place a value on difficult-to-quantify benefits like customer satisfaction or employee morale, making sure no important factor is overlooked. Helps prioritize projects. A CBA provides a clear framework for deciding which projects should take priority based on their return on investment, ROI, and potential net benefit. Forecasts risks and rewards. By predicting future costs and benefits, CBA helps organizations assess potential risks and rewards over a project's lifespan. Improves resource allocation efficiency. Organizations can better allocate resources by focusing on initiatives that provide the best return on investment. Limitations of cost-benefit analysis. Difficult to predict all variables. While cost-benefit analysis can help you outline the projected costs and benefits associated with a business decision, it's challenging to predict all the factors that may impact the outcome. Changes in market demand, material costs, and the global business environment are unpredictable, especially in the long term. Incorrect data can skew results. If you're relying on incomplete or inaccurate data to finish your cost-benefit analysis, the results of the analysis will follow suit. Better suited to short and mid-length projects. For projects or business decisions that involve longer time frames, cost-benefit analysis has a greater potential of missing the mark for several reasons. For one, it's typically more difficult to make accurate predictions the further into the future you go. It's also possible that long-term forecasts won't accurately account for variables such as inflation, which can impact the overall accuracy of the analysis. Removes the human element. While a desire to make a profit drives most companies, there are other, non-monetary reasons an organization might decide to pursue a project or decision. In these cases, it can be difficult to reconcile moral or human perspectives with the business case. Hard to quantify intangible factors. Assigning a monetary value to factors like environmental impact or brand reputation can be challenging, which may lead to oversights. Potential for bias. Decision makers may overestimate benefits or underestimate costs, leading to inaccurate conclusions. Time-consuming. Conducting a comprehensive CBA requires collecting accurate data, which can be both costly and time-consuming. Not always applicable. In some sectors, such as healthcare or environmental conservation, not every decision can be evaluated purely by monetary factors.